In this video, I share exactly why most retail traders get supply and demand trading completely wrong, and it's not what you think it is. I'm going to show you how to pinpoint killer high probability SD zones using what I call the A+ zone qualifier. It's my 4-point system to grade these zones, and only the ones that get an A+ make the cut. The real key to this is understanding how markets move based on where the big banks leave their footprints. Stay tuned because this is crucial. You might be thinking you've heard it all before, but I'll address that in a few seconds because I'm also going to reveal some seriously unconventional truths, like why less time the price spends at a zone is actually better. Yes, you read that right. And why ignoring a specific profit margin metric before entry is like placing a losing trade. Additionally, there's one secret way to get around those frustratingly wide stops with a concept I call zones within zones. The crazy thing about it was how simple these shifts are once you see them. But that's not all. I'll also show you exactly how my insane supply and demand strategy for finding supply and demand zones really works. I'm going to show you exactly how we focus on fresh zones and why the previous candles before a big move are so critical. You'll see how these powerful supply zones and demand zones look on a live candlestick chart, revealing where aggressive buying and aggressive selling truly originates. Plus, and this is the game-changing part, I'm going to show you my non-negotiable golden rule of drawing zones, a ridiculously simple technique to avoid fakes. And in just a few minutes, I'll show you how to master the first pullback entry for potentially jaw-dropping risk to reward ratio and high win rate trades. I've done the heavy lifting to give you 4 distinct take profit strategies, not just one, and a bonus tip using Fibonacci retracements to supercharge your SD zones. The way I knew that this was important? Well, let's just say I learned it the hard way so you don't have to. My goal is that by the end of this video, you'll possess a supply and demand trading framework so powerful, so logical, it'll feel like you've unlocked a cheat code. All right, with that said, now on to the fun stuff. So what is supply and demand trading? Let's backtrack to put it very simply. At its core, supply and demand is about identifying where overwhelming aggressive buying or aggressive selling has occurred. That's it. We're looking for footprints of the large institutions, the big banks, the smart money, what some call the big boys. Think of it like this. Demand zones are areas on your candlestick chart where buying pressure was so intense, so full of volume, that price had no choice but to rally. And the crazy thing about these demand zones, especially when they first form, is often just how quickly price explodes away from them. You'll typically find these sweet spots at the bottom of a really significant rally. And if you zoom in on your chart, you'll usually notice that the demand zone, it starts as this little area of consolidation, or sometimes just a really tight trading range. And then all of a sudden, the price breaks upwards with those strong momentum candles. This is where institutional order flow clearly showed its hand on the buy side. Therefore, we want to buy when the price comes back to this valid demand zone because we anticipate more buying. And what is a supply zone? Oh yeah, you guessed it, it's the exact opposite. A supply zone is an area where aggressive selling absolutely crushed any buying interest. The selling pressure was immense, which forces the price to just collapse. This is a premium price area where the institutions unloaded their positions or initiated massive short sells. Again, look for that initial period of consolidation before the market tanks, shown by those powerful red momentum candles. This is where institutional supply and demand is heavily skewed to the sell side. Therefore, we want to sell when the price revisits this valid supply zone, as we expect sellers to step back in. These SD zones tell us where massive volume came into the market, creating a significant supply and demand imbalance. This is fundamental to understanding how the price moves in any market. It's a science with a proven formula, really. When demand exceeds supply, price goes up. But when supply exceeds demand, price goes down. Simple, right? Now, why do these SD zones matter so much? I'll explain why in just a second. Because these zones represent areas on the price chart where significant institutional order flow originated. The big banks and institutional traders often don't get all their orders filled in that first explosive move, so they have a huge problem as they need to complete their business. So, when the price returns to these unmitigated zones, they often step back in, leading to a continuation of the original move. Therefore, this is where we, as smaller traders, can try to ride the trend with them instead of trading against them and getting crushed. This will help you avoid common pitfalls, but more on that later. Understanding these basic definitions of supply zones and demand zones is the first step. However, just seeing them isn't enough. Most retail traders can spot a bounce or a drop. The thing is, the real edge in our supply and demand strategy comes from knowing which of these zones are high probability zones and which ones are just noise, or worse, traps designed to take your money. And that's exactly what we're diving into next. All right, here's where the rubber meets the road, finding supply and demand zones on your candlestick chart and marking them correctly. I'm going to show you exactly how this isn't about just guessing where price might turn. It's about a specific, insanely effective method to identify where institutions and big banks likely initiated significant order flow. If you are struggling with this, pay close attention. Most traders are just drawing lines on old highs and lows, but you're doing that wrong. You should be doing it this way. Your first mission is to scan your candlestick chart for areas where the price exploded in one direction. We're looking for undeniable aggressive buying or aggressive selling. This is usually shown on the price chart as a series of big, decisive momentum candles. This sudden, forceful price action is your primary clue that significant volume from large institutions or smart money has just entered the market, creating a sharp supply and demand imbalance. This is how we begin finding supply and demand zones. Now, once you've found that price explosion, we need to trace it back to its exact origin. We look for the previous candles, prior to the impulsive move. If we can identify a very tight, small consolidation or trading range of just a few candles that existed immediately before that big move, we have identified a valid supply and demand zone. Now, for marking these supply zones and demand zones, I have a non-negotiable golden rule of drawing zones, which is, we don't cut through candles. Keep in mind, you do not want to ignore this rule. This is vital for accuracy. Take your rectangle tool, or the box tool as some call it. For a demand zone, you will draw your box to cover the entire trading range of those previous candles right before the aggressive buying and strong upward momentum candles appeared. Draw your box from the absolute lowest point to the absolute highest point of that trading range. For the supply zone, it's the exact opposite. You will draw your box to cover the entire trading range of those previous candles right before the aggressive selling and strong downward momentum candles took over. Again, your box must cover the entire trading range of those previous candles, from its low to its high, including all wicks. Why the whole candle, wicks and all? Because I found out that wicks show us where price attempted to go but was forcefully rejected by either buying pressure for demand or selling pressure for supply. That whole area represents the battleground where the institutional order flow made its decisive move. Getting that price consolidation marked up just right, well, that's what gives us our starting point for a valid demand zone or valid supply zone. But that's not all. Now, just because we've marked an SD zone doesn't automatically mean it's a high probability zone ready for trading supply and demand. Not all zones are created equal. Far from it. The crazy thing about it was how many retail traders fall for weak zones. Most retail traders stop there, but they have a huge problem. Their supply and demand strategy often fails as a result. But the good news is, there's one secret way to get around this. We need a quick BS detector. You might be thinking this is complicated, but I'll address that in a few seconds. Coming up, we're going to put these marked zones to the test with my A+ zone qualifier to see which ones have the real institutional backing and are worth your attention for potential entries and exits. The next crucial step is to separate the A+ high probability zones, the ones truly backed by big banks and institutions, from the wannabe SD zones that are just noise or worse, inducement traps designed to steal your money. So, how do we filter out these junk SD zones and find the institutional gold? I'm going to show you exactly how with my brutal, unforgiving checklist called the A+ zone qualifier. This is where the wannabes get separated from the pros. I've done the hard work to figure this out. Forget your feelings, forget the news. Does your SD zone passes the test? Let's find out. Here are the 5 essential A+ zone qualifiers. These are the critical filters, the core of finding supply and demand zones. The first qualifier, when price left your marked supply zone or demand zone, was the price moving slowly with pullbacks, or did the price explode out of there like a rocket? This will help you identify true institutional intent. What we really want to see is that undeniable aggressive selling if it's a supply zone, or that super strong aggressive buying if it's demand zone. What does that look like on the candlestick chart? Well, it means you're seeing these big, powerful momentum candles that leave no doubt about the direction and the volume behind them. Sometimes you'll even see a gap, but not so much in spot Forex. Look at that. That is exactly what you want to see. So when you see price blast out of there, like almost violent exit, it's a massive clue. It tells you the supply and demand imbalance at that spot was just huge. And it also means those large institutions were seriously committed, you know? So it just makes sense. The stronger that impulsive move is, the better the chance that the order flow right at that starting point is really significant. This is a key indicator of how markets move with force. If it ain't strong, it's wrong. That point was super important, but if you don't also couple it with this one, then you're still missing a piece of the puzzle. The second A+ zone qualifier is, how much time did the price spend at the SD zone? This next trading tip is even more important than the last one, but this one trips up so many traders because it's counterintuitive to what most trading books teach. They say look for lots of consolidation or activity. No. You know, that's a common mistake. Think about it. If there's a true massive imbalance, Like, let's say, 1,000 institutional buy orders at a demand zone and only a handful of sell orders available. Do you seriously think the price is going to stay at that level for a long time, forming a whole bunch of candles? Of course not. Absolutely not. And the crazy thing about it was that aha moment when I realized, wait a minute, if the imbalance is that huge, price isn't going to wait around. It's going to get those orders filled and then rally quickly. So we want to see minimal time spent at the origin of the move. Very few candles, ideally 4 to 8, forming that trading range box or tight base. This indicates that the buying pressure or selling pressure from the institutions was so overwhelming that the level couldn't hold price for long. More candles often mean more balance, which means less of a trading edge for us. This is a subtle but powerful clue when finding supply and demand zones. It's a science with a proven formula. Now on to the fun stuff. Next up, the silent killer of most supply and demand strategies, ignoring the profit margin. You might be thinking this is obvious, but I'll address that in a few seconds. This is absolutely critical for your risk to reward ratio and determining if a zone is even worth considering for potential entries and exits. It's all about the initial profit margin created by the zone. If the price barely moves a few pips away and then comes right back, then what's the point? You're risking your capital for almost nothing. Keep in mind you do not want to make this mistake. Here's the rule. After price leaves your supply or demand zone, that initial uninterrupted move away must be at least 3 times the height of the SD zone itself. I'll show you an example. So if your supply zone is 10 pips tall, price needs to sell off at least 30 pips before it even thinks about pulling back for an entry. If it doesn't meet this insane 3x criteria, it's not a valid zone in my book. That initial price rally is what creates your profit zone. No blast off, no trade. Simple. But without this next step, this rule alone isn't enough. You've seen it happen. You spot what looks like a beautiful base, then the price rallies. You're thinking, this is it, perfect demand zone. And you quickly place your buy limit order. And then, bam, price just tickles your entry and then gets absolutely smashed down. So what went wrong? Why did that happen? I'll explain why in just a second. Because you didn't look at the actual profit zone. If there's a brick wall of a supply zone sitting just inches above your perfect demand zone, where do you really think the price is gonna go? Let's be real, the big banks aren't out there making dumb moves. The thing is, what so many retail traders forget is that these guys need space on the chart to lock in their profits. Simple as that. Let's be real. The profit margin is the clear space between your entry zone and the first significant opposing SD zone. If that profit zone is tight, then forget it. It's not a high probability trade. It's just a classic trap. And how do I know? Because I walked right into that one myself plenty of times before I figured it out. This is a non-negotiable for a valid demand zone or valid supply zone in my book. So this video is all about drilling these critical points home, the 4th A+ zone qualifier. We've hinted at this, but this is probably the most important thing that you need to be doing if you trade supply and demand that you are probably not doing. This is a standalone qualifier, the freshness of the SD zone. All right, now listen up, because this is where most retail traders absolutely screw up their supply and demand strategy big time. They find an SD zone, right? Price touches it. Maybe it works once and suddenly they think they've discovered a magic money printer that's going to last forever. That's wrong. So incredibly wrong. And believe me, the way I knew just how flawed that thinking was by meticulously tracking countless trades and seeing it fail over and over. The mantra is fresh SD zone only. Listen, if there's one trading secret the top pros live and die by, it's this simple truth: fresh SD zones are king. Nothing else comes close. We are primarily interested in the first clean pullback to a supply zone or demand zone that have not been retested since their creation. But hold on. Choosing the right fresh zone is an art in itself. And next, we'll dive into those crucial details. Now, you might be wondering, why all the fuss about fresh zones? What makes them so special? I'll show you exactly why. It's because these SD zones are the direct result of a massive underlying imbalance, which leaves behind a lot of unfilled orders just waiting there to be filled. Think about it. What actually moves price? Is it the trades that already happened? The candles you see printed on your chart? No, that's history. It's the unfilled orders. It is those buy orders waiting below and the sell orders lurking above the current market price. So the liquidity waiting to be hit is what causes price to turn on a dime. Think of it like this: a demand zone is like a wall of buy orders from big banks. When the price comes down for the first time, it hits that wall, orders get filled, and then the price bounces, right? But here's the kicker. Every time that happens, it's like a few bricks get knocked out of that wall. So some of those buy orders are gone. So the second time the price attacks, the wall isn't as strong. The third time, even weaker. Makes sense, right? Do you get it? And this is exactly why. Once an SD zone gets retested over and over, its strength just drains away. But the good news is, by focusing on fresh zones, you dramatically increase the risk-reward ratio in your favor. This isn't about some random line you drew. This is about understanding that every supply and demand level is created because of another level's existence, an imbalance that needs to be resolved. This isn't about waiting for a million confirmations after the fact either. It's about anticipating where the smart money will defend their initial price action. Stay tuned, because coming up, I'll show you exactly how to enter these SD zones. The fifth A+ zone qualifier is, how does the price arrive at our SD zone? Now, let's backtrack to put it very simply, because this next part, this fifth A+ zone qualifier, is absolutely crucial, and it's not what you think it is. You see, the big secret, the thing that most retail sheep just don't get, is that understanding how price comes back to our supply or demand zone is like spotting a genuine fire sale in a store. This is probably the most important thing that you need to be doing if you want to succeed with high probability SD zones that you are probably not doing. You're not analyzing in what manner is the price pushing back into the SD zone. We want to see the price pulling back into our supply and demand zone with big, fat, decisive candlesticks. But what does conventional technical analysis tell you? Buy the breakout, wait for the uptrend. Confirm your trade with these 17 insane lagging indicators. But by the time all that confirmation hits, guess what? The institutional order flow has already milked the move, and the best part of the move is gone. You're doing it wrong if you're scared of strong momentum candles moving into a quality SD zone. If you see strong momentum driving price into a pre-qualified quality SD zone and your first instinct is fear, you're looking at it all wrong. The shift you need to make, the way you should be doing it, is this: learn to embrace that aggressive push as a positive sign, a confirmation. Because otherwise you'll be taking high-risk, small-reward trades. The crazy thing about it was how long it took me to unlearn this garbage. Think about it. When the price is plummeting into a juicy demand zone on big, scary red candles, or rocketing into supply on big green ones, what is every fiber of a typical retail trader's being screamed? Sell? Get out. It's getting to zero. Or FOMO buy. It's going to the moon. You might be thinking this strong move against your potential trade direction is a bad sign, but I'll address that in a few seconds by telling you it's often the exact opposite. But get this. If that zone has passed our other A+ qualifiers, that strong, decisive push into it is exactly what institutional traders want to see. Now, you might be thinking, why? That sounds counterintuitive, and here's the aha moment. Those big, fat candles often scream one thing: retail traders are panicking. They're either dumping their positions in fear right into demand, or they're chasing the price like crazy straight into supply. If the price is just slowly moving into an SD zone, it often means the retail crowd isn't committed enough, not enough panicked participation providing enough liquidity for that sharp, satisfying reversal. But the good news is, you can learn to spot this too. You have to understand that the price doesn't decline into demand zones on a wave of optimism, but it arrives on a tide of fear. Now, if you're out there struggling with that feeling, if you find it hard to pull the trigger and buy when you're scared, this next thought is a game changer. This will help you break through. Just keep reminding yourself that the institutions, the smart money, they thrive on buying that exact fear from the panicked crowd. If you can't buy when you're scared and sell when you're greedy, you will never consistently profit from supply and demand trading. It's a science with a proven formula for them. Stop looking for what is easy or confirmed. Instead, start looking for where the actual institutional buying and selling pressure is. You'll take fewer trades, but then your win rate on quality setups will skyrocket. All right, if learning these kinds of institutional secrets and trading strategy tips is why you're here, then do yourself a favor. Hit that subscribe button right now. Look, you do that not because I'm just telling you to, but because if this already gave you an edge, you know the next video will too. You don't want to miss out on that edge, do you? Okay, let's move on to how we actually enter these A+ SD zones. All right, so let's say you've put in the work. You've found that potential supply zone or demand zone, you've nailed the marking with the golden rule, and it's passed every single one of our tough A+ zone qualifier tests. The big question then is, now what? What's the crucial next step? How do we actually enter these high probability zones and manage our trade to aim for those high win rate trades? Well, stick with me because I'm going to show you exactly how. If you really want to learn the precise entry model for these A+ setups, then this is it. This is the part you can't afford to miss. This is where your entry models and exit strategy come into play. Here are a couple of simple yet insanely effective ways for trading supply and demand entries. And then, right after that, of course, we'll talk stop loss and take profit. Now, listen closely, because whatever you do, keep in mind you do not want to be making this up as you go. This isn't guesswork. This is where precision execution pays off big time. One straightforward way, especially if you can't be glued to your candlestick chart, is using a limit order. I'll show you how. For a qualified demand zone, you would place a buy limit order right at the edge or the top resistance line of the demand box. For a qualified supply zone, you would place a sell limit order at the bottom line or the support line of the supply box. The idea here is that if the price returns to this powerful institutional order flow area, your order gets filled automatically, aiming to catch the continuation of the move initiated by institutions. This is a passive trading approach relying on the strength of the SD zone itself, which we've already validated with our A+ zone qualifier. Therefore, it leverages the idea that significant unmitigated zones still hold liquidity. But here's the deal. If you skip this next step, your entry might as well not exist because it's dangerously incomplete. I'm talking about your stop loss. This isn't just some optional extra. Your stop loss is what stands between you and blowing up your trading account. And I can't stress this enough. In the world of supply and demand trading, using a stop loss isn't just recommended, it's absolutely non-negotiable. No ifs, ands, or buts. For a buy order, your stop loss goes just below the demand zone. And then obviously for a sell order, the protective SL goes just above the supply zone. Now, here's a key thing I always do. I give my stop loss a little bit of breathing room and place the SL just a few extra pips outside the actual SD zone. That tiny buffer is your vital protection against the broker's spread and those frustrating little minor stop hunts that the market loves to throw at us. And this is one of the best things about trading these super well-defined supply and demand zones that have made it through our rigorous A+ zone qualifier. It gives you a crystal clear invalidation point. If the price decisively breaks beyond that zone, your trade idea is pretty much invalidated. And then, you're out. Simple as that, with a small, controlled, managed loss. We are not sitting around biting our nails, hoping and praying for some kind of miraculous turnaround. All right, now let's talk about a part of the trade that's just as critical as your entry, if not more so. And that's where you actually plan to take your profits. And the good news is, I'm not just going to give you one trade exit idea. Oh no, I'm going to lay out 4 incredibly powerful yet surprisingly simple and actionable approaches for your exit strategy. All right, approach number 1 is super logical. Take the profit at the next opposing qualified SD zone. If you bought from a strong demand zone, your first logical take profit could be the nearest qualified supply zone above, and vice versa. This is a really smart way because it helps you lock in those profits systematically based on where the market itself is showing potential turning points. Next up is a classic for a reason. It is all about using a fixed risk-reward ratio. You know, many successful traders swear by this. They aim for a set target, like a 2-to-1 or maybe even a 3-to-1 risk-reward. So it's super simple. If your stop loss is, say, 20 pips, you'd be shooting for a 40 pip or a 60 pip take profit. When you get it right, it's a science with a proven formula. The third take profit strategy involves looking at the bigger picture and target a significant swing high or swing low. So if you're in a buy trade, you might set your sights on a recent, significant swing high. And if you're selling, you would look for a recent, significant swing low. The key here is making sure it actually aligns with the overall market structure and, importantly, still offers you that good, healthy profit margin we've talked about. Don't just pick any old swing. But that's not all. We can also use tools like the Fibonacci retracement and extension levels, or even multi-time frame analysis to refine take profit targets, but more on that in a second. The key is to have a plan for your exits before you even enter the trade. Don't make it up as you go along. Good trading supply and demand is about process, not panic. And that point about having a plan, it was super important, because if you don't also nail down your exit strategy beforehand, then you are absolutely 100% just leaving money on the table. All right, now on to the really fun stuff, the kind of stuff that can genuinely take your trading supply and demand to the absolute next level. For those of you who are truly ready to elevate your Forex trading game, listen very closely. Here's one of my favorite secret weapons, a ridiculously effective, almost unfair advantage, a way to get around those frustratingly wider stop losses. It's all about trading lower time frame zones within higher time frame zones. And in just a few minutes, I'll show you how to apply this. This SD zones within SD zones trading approach is a fundamental pillar of my supply and demand strategy, and it taps directly into the fractal nature of markets. So, picture this. You've identified a really strong looking daily demand zone. Looks promising. But now, check this out, because this is cool. 9 times out of 10, if you just drop down your charts to a smaller time frame, like a 1 hour or even a 15-minute chart, you're going to discover an even tighter, more refined demand zone tucked away right inside the higher time frame SD zone. Now, you might be thinking, okay, that sounds cool, but why is this zones within zones strategy so incredibly powerful? What makes it such a big deal? Well, let me break down the 3 massive advantages for you. First, your stop loss can now be placed with pinpoint accuracy just below this tiny lower time frame SD zone, which means you're drastically reducing your risk exposure in raw pips. Second, because your stop is so much smaller, while your take profit target based on the higher time frame can remain the same. Your potential risk-reward ratio can go absolutely through the roof from, say, 2 to 1 to an insane 5 to 1 or even more. This is where the big money can be made. Lastly, you're pinpointing the most reactive part of that larger institutional order flow area. So, the process is: first, identify your A+ qualified SD zone on a higher time frame, like for example the 4-hour or 1 hour. As price approaches it, drop to a lower time frame, like for example the 15 minutes or the 5 minutes chart. But keep in mind, you do not want to go too crazy low. Stick to logical steps like daily to 4-hour, 4-hour to 1 hour, and 1 hour to 15 minutes. Look for a fresh, well-formed supply or demand zone on that lower time frame within the boundaries of your higher time frame zone. That smaller zone becomes your new, high-precision entry target. This is the beauty of using multi-time frame analysis. It's all about dialing in that extra layer of sniper precision entry. The magic of the zones within zones. Trading technique is that it doesn't necessarily change your ultimate take profit target on the higher time frame. It just dramatically improves your risk reward to get there. If you like this part, smash that like button. So, always remember this. The real goal here isn't just about blindly finding supply and demand zones on a chart. Anyone can draw a box. The real power comes from learning to engage with them intelligently, knowing which ones to trade, how to enter, and when to get out. And the whole purpose of this video, every single trading tip and trading strategy I've shared, is designed to give you exactly that. Alright, for those of you who are really sticking around, the dedicated ones, and if you're absolutely serious about not just understanding, but truly mastering supply and demand, then I've got a special bonus trading tip that can genuinely blow your mind. But before I reveal the tool itself, let me explain why this concept is so incredibly powerful, because it's a foundational principle for me. You see, I never just rely on one single thing, one isolated trading signal. The real magic, the high probability edge, comes when I find confluence, meaning when multiple, independent reasons all pointing to the same conclusion. And one insanely powerful tool for finding this kind of game-changing confluence is the good old Fibonacci retracement. Let me show you exactly what I mean, and how simple this can be. So, just imagine this for a second. You've identified a really strong A+ demand zone that meets all our tough qualifier criteria. And then you pull up your Fibonacci tool, and bam. That SD zone lines up perfectly with a key Fibonacci retracement level, say the golden 61.8%. Now, my trading friends, that right there is what I call an A++, platinum grade, high probability zone. So when you start seeing these kinds of multiple confirmations, these beautiful layers of confluence all stacking up and screaming the same thing, your confidence in that trade should increase. The crazy thing about it was how much this improved my win rate. For experienced traders, this might even be a reason to consider a slightly larger position size, like going from 1% risk to maybe 2% or 3% risk, if your trading plan allows. However, be cautious with this because this isn't an excuse to get reckless, so be very cautious here. Alright, now on to some more seriously fun stuff. Let's talk about the 4 core foundational patterns you'll see again and again in supply and demand trading. I'm going to show you exactly how mastering these simple patterns will help you instantly recognize the exact moment of birth of a brand new supply zone or a fresh demand zone. So here are the 4 patterns that paint the picture of institutional action. First up, we've got the rally-based rally. This pattern clearly shows strong buying pressure creating a fresh demand zone at that base. And then, instead of the price dropping at rallies again, even harder, go ahead check this out on your charts. You'll see it everywhere once you know what to look for. Next, we have the drop-based drop. As you would expect, this pattern shows overwhelming selling pressure creating a new supply zone at that base. You know, it's the perfect mirror image of the rally-based rally pattern. Now, let's switch gears to the reversal zones. We have the rally-based drop. The price rallies up. It forms a base at the top. But then, instead of going higher, the price drops hard from that base. That base at the peak, right before the fall, just becomes a new supply zone, showing where sellers took control from the buyers. And finally, the opposite reversal, the drop-based rally. Price is falling. It hits a base at the bottom. And then, instead of continuing down, it rallies strongly away from that base. That base at the low, right before the big upward move, just becomes a new demand zone, showing where buyers overpowered the sellers. Understanding these 4 patterns is truly powerful stuff for reading the price action. So, these 4 incredible patterns are simply the visual ways institutions create our supply and demand zones. The base in each pattern is that key tight consolidation we learned to mark. Once you truly see these patterns for what they are, it's like unlocking a science, a proven formula for reading institutional intent. Now, if you're ready for even more unconventional truths about how markets move and want to see another insane trading strategy the big banks don't want you to know, then check out this video right here. Go on, click it. Not because I told you to, but because you know this channel delivers those game-changing institutional secrets, and that next one, yes, it's packed with even more of them.